It is Wednesday, January 22nd, 2025, and it is time for this week's episode of Navigating the Markets with me, Markets and Mayhem. First, quick risk disclosure. All trades and investments involve the risk of financial loss. The value positions can go down as well as up. Past performance does not guarantee or predict future results. A little bit about me. I've been trading for 20 years. I know that dates me, but I've loved every minute of it overall. Obviously, there's been some downs, there's been some amazing ups, and all kinds of turbulence in between. But one thing I'll say about the markets is they keep you on your toes. You're always forced to keep growing, to keep evolving, to always be willing to adapt and change to market conditions if you want to survive in this game. And that's, to me, what keeps it really exciting. And having been at this game for 20 years, I did go through the great financial crisis, the COVID crash, Fallmageddon, all that sort of fun stuff, and really had me appreciating risk management and systematic trading more and more and more throughout my trading journey. The less we let emotions guide our compass, the better off we're going to be over the long run. Another thing I say all the time is I like to roll my trading profits into other investments, stocks, fixed income, real estate, business ventures, and otherwise, because it makes sense. That's how you really build generational wealth over time. So my approach has evolved from being discretionary in the beginning days of my trading to much more systematic, much more driven by data. So I look at momentum, price action, options flows, positioning, volume profile, and the big picture. And I try to distill that into actionable data with the tools I provide to the Traderade community, my market commentaries, and otherwise. And Traderade now is going on 3 years old, which is pretty cool because most businesses don't even survive past their second year. But we're going on our third year. I think we have many amazing years ahead of us, but really it's like pretty much this week that we're celebrating our third birthday. So happy birthday to us. So let's get into the market overview here, talk about what's going on. This is going to be a kind of more compact episode because it's been a more compact week overall, but I like what I'm seeing. We talked about this on the Traderade Discord during the market prep, right? There were a few levels we wanted to push above. SPX 6000, ES 6046, those were some keys. We want to see a close above for continuation. We got that close above and we got the continuation. Also had Netflix deliver phenomenal earnings. Their guidance was a bit soft, but they are raising prices, buying back shares, investing in more live streamed and pre-produced content. That's set off a lot of other kinds of sympathy bids across tech, excitement ahead of mega cap earnings, which really kick off into full gear next week. So I think next week's going to be a really important week, but overall, all these momentum factors are turning right back into positive. New highs versus new lows. You look at the number of stocks that are above their 20-day, 50-day moving averages. You look at the McClellan oscillators for the NASDAQ, for the New York Stock Exchange. You look at MACD histogram on the bottom of this chart. Everything looks pretty solid here. You could see once S&P was able to break above that 50-day, that released a lot of energy. That's that blue line on the screen. So I think that here we are with an opportunity for this to potentially extend to new all-time highs. We've certainly changed the trend near term, right? If you just look at a trend in very simple terms, lower highs and lower lows, right? So we had that sort of series of lower highs, lower lows. Wasn't perfect, right? These lows aren't necessarily lower here, but it was still a downwardly trending market. And then things really turned around on that cross above the 50-day because we could see now we've made a higher high from this trend. So overall, this is a market that I think wants to move higher. We do have some formidable resistance up there at S&P 6100. There's a wall of calls there, but we see positioning rolling higher. So it does look pretty constructive overall. And we'll go over the options picture in just a moment. The NASDAQ chart looks a lot like the S&P. Momentum now decisively flipping positive. No longer a series of lower highs and lower lows on the NASDAQ. Now you've got that momentum back in tech. You could see that taking shape today, Microsoft, Nvidia, Amazon, Netflix, Palantir, CrowdStrike, Arista Networks, Oracle, all these tech stocks really surging. And even over the last week, with the big exception of Apple, no one wants to let Tim Cook. I get it. There's some growing skepticism about the company's innovation or the lack thereof. But the rest of tech and really this broadening out of the rally that we've been seeing looks broadly constructive. You've had more highs versus new lows building on the New York Stock Exchange for many trading days back to back. When you have that type of action, that tells you there's a broadening out of the buying in this market, that momentum is broadly turning positive. And this was after a time where we had been making more new lows than new highs for weeks at a time. So this turnabout is very constructive, and it does suggest that we could continue this positive momentum push. Now, coming right up here overhead is S&P 6100. We've played with that level a little bit today. We backed off of it. It is acting as a wall of calls overhead. Below us, we have some options implied support at 6050 and 6000. And we can see on the chart, positioning is rolling up here to 6150 as well. So you're seeing more and more confidence in higher prices. You're also seeing call positioning rolling up higher to 6,200, 6,250, and 6,300. That is a vote of confidence, and you're seeing some of that put positioning at lower levels. Well, it's not building, and after options expiration, some of that actually started to roll off. So you're seeing trading desks expressing more confidence. We want to watch for a break above 6,100 on a closing basis, or what I like to call those wall hops. You know, when pre-market, we get right above one of these key levels and we open, never look back. That wall hopping is very common pre-market if we have some good news. Let's say it's from earnings or economic data. So we could look for a potential wall hop above 6,100 as well. Now, a couple words of caution because, I want to balance the good with the bad, make sure we still have our risk management radars up. Volatility is still something that seasonality favors over the last 2 decades during this period of time, really from now all the way through March OPEX. So just keep that in the back of your head alongside the fact that S&P 500 book depth, or the liquidity that helps to drive the futures market and absorb the buying and selling, is lower than usual. So that means you can have larger moves intraday that can shake out weak hands that have tight stops. The way I approach this is if I'm going to be trading, I'm taking smaller size and I'm widening out my stops. Another thing to take into consideration is stocks typically face some post-election resistance. That doesn't mean that past is prologue, but when we go back to 1932, this is the median trend of the S&P from elections. You see just a bit of downside over the next sort of, I would say about, 4 months or so? So that doesn't, again, mean that that is a surefire path. There are all kinds of catalysts that can counteract this potential seasonality-driven increase in vol and the post-election trend of the markets to sort of consolidate and move lower. But we would be remiss not to pay attention to these things. Now let's zoom out a little bit more to the big picture. One area that I think is very interesting is the dichotomy between the Magnificent Seven and the Inglorious 493. One question I asked leading into this Navigating the Markets is, will 2025 be the year of the Great Rotation? I think it could be. And here's why I think that. This chart in front of us illustrates a big earnings-driven premium, one that has existed from really 2023 through 2024, and where we do still see in the broad aggregates 2025 being a year where earnings growth is expected to be quite strong for the S&P. But what makes this interesting to me is where is that growth really coming from? And we're seeing more of it coming from the Inglorious 493. And that gap set to narrow even further next year. So what that tells me is there could be opportunities in places like RSP, or the equal weighted S&P 500 this year. I would want to wait for relative strength of RSP versus SPY. to show us that there's that opportunity playing out. But so far, and we'll watch this earnings season to see if there's any signs of this kind of handing off of the baton starting in the fourth quarter of last year. So far, there are signs of this in the broadening out of the rally that we've seen, including more sectors and industries that are sort of older economy, both beneficiaries from tailwinds like deregulation, but also the presumption of improved earnings and margins expansion, which could also experience a tailwind from a less regulatory-centric administration. Now, another area that's caught a lot of people's attention has been the dollar. And I think the dollar has had a fantastic run, but it is due to correct a bit more from here. I would not be terribly surprised to see the dollar actually give back a lot of those post-election gains, especially if tariff talk really does soften. If we don't see a whole lot of tariffs kicking in Feb 1st. We've heard 25% for Canada and for Mexico. We've heard 10% for China. We've heard some rattling about what might happen to the EU and their trade dynamic. I think that a lot of this stuff is more talk than substance. Personally, I think it's a negotiating strategy. Try to bring parties to the table to figure out what President Trump would see as being a more fair trade dynamic. But nevertheless, if that ends up being the case, if in just over a week we see that a lot of this isn't necessarily any more than tough talk to begin with, that does set up the dollar to move lower. Another thing is rates on the long end starting to pull back a bit. The 10-year now trading about 4.6%, down from its high of around 4.8%. That also tends to lead the dollar lower, that softening of long end rates. So we'll be paying attention, but I do think that could set up some interesting trades because I'm still longer term dollar bullish. I think that any pullback that we see in the dollar could actually be an opportunity for resuming some of those fade trades against some of those pairs like the euro, the yen, and otherwise. And the other part of the dollar that has me interested is the positioning. It's become very, very lopsided to the long side. So again, let's watch and see exactly what plays out with the dollar, but various measures of flow and positioning in the dollar do look extended. Shifting to global liquidity. This has been a really important driver of the market, and we can see that global excess liquidity is dropping pretty sharply. That does, again, suggest there could be some increasing risks to stocks and other risk assets, and also some potential tails for volatility to play out. In a lower liquidity regime, volatility tends to be on the rise. So that means we just want to be a little more selective as to where we're taking trades, what kind of size we're putting on. I lean towards smaller, and how we place our stops. I lean towards wider to account for some of these structural shifts that are happening underneath the surface. Another area we've talked about, and I highlighted with the 10-year at 4.6, we're still above that line in the sand of 4.5%. Now, the rate of change matters a lot, but the actual yield matters too. And the reason it matters is there's over $100 trillion of global debt that keys off the 10-year note interest rate to price it. Add to that most of that debt is denominated in dollars. What that tells you is when rates and the dollar rise, that can put stress on global liquidity, on the availability of capital to allocate into other areas like stocks. So that is why we watch the dollar and rates for signs of those financial conditions starting to tighten, because it tends to be a bit of a headwind when the dollar and rates are rising on the long end. On the other side, when they're coming down as they are right now, it can be and has been a tailwind. Another interesting area, this kind of drives home the point about liquidity. This is the book depth of the S&P 500 E-mini futures contract from the CME. And you can see of late, this level of liquidity is quite a bit lower than what we've seen during other trading regimes, sans the little dips when there are event volatility catalysts. We are broadening out a bit, so perhaps we'll start to see liquidity broaden out. But even so, the amount of book depth we are seeing in the S&P this year is quite a bit lower than last year and the year prior. It just gives you a sense that, again, you need to be a little more nimble trading these contracts and also trading the S&P components. This is a market that with the right catalyst or just flow can move very quickly in a short period of time. Let's shift overseas for one last chart. China is expected to see the longest deflation since the 1960s. Now, the reason I mention this chart is, for one, more folks are expecting Chinese stimulus this year. It's been about 2.5 years of let's talk a lot about it and do very little. We'll see if this ends up being the year where it really happens. If it is, I think it'll be incredibly bullish for copper and silver. And I think it will also be good overall for swing trades. I wouldn't be investing, but swing trades in Chinese equities. So now I just want to quickly highlight opportunities. I've shared some in the Traderade Ideas channel last week and this week. There's a new idea I've just put out today that I think could be a pretty good swing over the next 2 months. So check that out if you're on the Traderade Discord. And then I want to get into questions and answers. If you have any questions about anything, let me know. And while we're waiting for any questions, I just want to send out my best wishes to everyone out there tuned in. I hope you all are faring well so far in 2025. I know that it's been a year with some shakeouts. There's been some folks that have done really well. There's been some folks that have gotten a little bit beat down. There are some folks that are looking around trying to get used to this new dynamic. If you didn't trade in 2016 through 2020, you may not be as used to, or really 2017 to 2021, but you may not be as used to that sort of Trump headline risk where you can just sort of tweet something and send the markets into a fit. Be very cognizant of that. I don't know that it's going to be the same now that it was then, but we're sort of starting off with that potential, you could say. So that's another reason to be careful with position size and how you manage your risk, because one of those tweets can shake people out on either side of the trade. Buckman asks, what should I invest in? Buckman, that is a very good question, but it's also a deeply personal question in the sense that I don't know what your financial situation looks like, or what your goals are, what your age is, how much capital you have that you would want to put at risk, what your growth versus capital preservation goals are. What I can say for my own self is what I want to be investing in this year are some of the overlooked areas of opportunity. And that's what I do try to highlight. I still think gold can get to $3,000. I still think there's opportunities in the overall hack or cybersecurity ETF. I still think that RSP, or the equal weight S&P, has an opportunity, but I do want to see it outperform SPY for a few weeks to really get excited about that relative strength. So those are some starting points. We're still in an unsafe world, so I think aerospace and defense still makes sense to look at. And I think that commodities could have some juice, but we need to see whether China stimulates. Strikes and Gutters asks, not a macro guy, but J&J beat and had seemingly good headlines with it. Any reason for the drop today? And do you like it overall as a potential investment or as a company? So let's take a look. I will admit that I was not really watching it today, but I'm happy to take a look and just get a kind of big picture view. So they're down about 2%. And chart to me, and we'll just pull this up on screen so that everyone can kind of benefit from seeing the same thing. But the chart to me looks like it's been in a broad downtrend for about 4 months now, maybe 3. Lower highs, lower lows, crossing below key moving averages, rejecting here pretty clean on the 50 yesterday. So there's just some broader distribution for one. And I think that's something that prompts a little concern. Someone who knows a little bit more about the situation perhaps is basically scaling out of their position in the company. It's not a particularly cheap stock. It trades at a PE of 25. I know that seems like cheap compared to the MAG, but it doesn't grow like they grow, right? It has, let's take a look at some of its stats here. Looks like quarterly revenue growth of about 5% overall. Earnings growth has been poor for some time in the negatives. I have not looked at their most recent earnings, but I don't see a lot to love with this one. So, it's got maybe a decent profit margin of 16.74%, but nothing terribly impressive. So for me, I don't like the trend first and foremost, because for something like this, I need it to show signs of broader accumulation. I think maybe if we zoom out, we could see some signs of that trend even being more intense. So yeah, we can zoom out to 2021. And we can see even with this rip-roaring bull market that we've had kind of on and off since COVID, this thing has just been sliding and sliding and sliding lower. So for me, there's just nothing to like about Johnson & Johnson and the technicals and the momentum picture. I have to admit, I didn't see their earnings, and I don't have a lot to go off of there. But I think the market is giving us a pretty clear sign that at the very least, this thing's going to consolidate for some time without a broader catalyst. And it has just a multi-year downward trend that suggests to me it could start to make even further 52-week lows. You're very welcome. Great question. CP12 asks what my upside and downside targets are for SPY. I don't know if there's a time frame. Do you have a time frame for that? Because, I don't really put out targets as much as identify key levels that can be decision zones for the market. But even that varies widely depending on whether it's intraday, over a week, over a month, etc. What I would say is that I expect this to be a market that isn't just going higher this year. I think it's going to be a market where there is more turbulence, where there is more volatility. It is why my theme is make volatility great again. I'm not just playing around because it's a funny phrase. I'm being quite real that I think a drop in liquidity, tightening overall financial conditions, a Fed that's not going to cut as much, the fiscal side that seems like they're going to do what they can to, instead of increase spend, they're actually looking to cut spend to justify their tax cuts. I think there's a lot of reasons to be a little more concerned about where the upside catalysts. The AI narrative is still strong for now, but yeah, I would be looking for, let's just say the end of Q1. If we're looking at like the next kind of period of time, by the end of Q1, I would expect S&P probably to be trading in the high 5,000s. I don't know that we're going to be able to hold on to the current levels that we're at without some really, really strong earnings and guidance being delivered this earnings season, and without further signs of both the economy remaining firm, but inflation showing signs of further deceleration. For now, I still think rates on the long end, the lack of demand for that debt, and the overall liquidity coming out of the market, and signs that institutions are selling down some of their positioning as well, gives us a sense that we may have seen recent highs for some time. But we'll see. Obviously, the way the market's positioned from a momentum perspective, we could make a meaningful higher high in the near term. But I would still say over the next 3 months, or basically to the end of Q1, I think it's more likely we're in the high 5,000s than where we are right now. That would just be my guess based on the factors that are in front of me. There's a lot that can shift that view, and we're very, very early on into a new administration. So I really do want to get a sense as to more of not only what are their priorities, but what of those priorities are actually things they can achieve. Because even though they have a majority in the legislature, it's a narrow one, and there's disagreements within the Republican Party about priorities. So that's going to do it for tonight's episode of Navigating the Markets. Thank you, everyone, for tuning in. And if you have any questions, feel free to reach out. You can always email mayhem@traderade.com. Tune in next week, Wednesday at 5 p.m. Eastern for the next episode. I'll catch you then.